Hi, everybody. Welcome to today's office hours. We'll get started in just a minute or so. All right. Hi, everybody. Welcome to today's ESG-CV state recipient office hours. Today's topic, we're going to be talking about financial management. Next slide. All right. After today's presentation, everybody who has registered for this webinar will receive a slide deck and a copy of the chat and the Q&A content that will be shared with everyone within 2 to 3 business days. And then we're really excited to let everyone know that an archive of these state recipient office hours, which includes the recording and the meeting materials and the chat, is now located on the HUD Exchange at the link below. As you all know, we're using Zoom, which I think most people feel very comfortable using by now, but just so everyone knows that for this presentation, everyone is muted. And if you do have any questions, please feel free to use the Q&A or the chat box to ask your question. Also, if you have any desire to learn about additional financial management topics, please put them in the chat, because we would like to kind of keep this going and talk about more financial management topics in the future in these office hours. So if there's any areas that you desire to learn more about, please put them in the chat. We do have tech support here today. Laura Harris is supporting us. So if you do have any technical issues at all, please feel free to message Laura in the chat and she can assist you. Next slide. So today we do have Marlisa on the line. She's not going to be presenting, but she is our expert in all things ESG that is available to provide assistance. And today we are going to be led by the team at Corporate Facts, and William Rotard and Andre Brickhouse is going to be our presenters. Next slide. I do have a couple announcements before we get started. As many of you may have noticed, the updated HIC and PIT count notice was released by HUD. That is going to be talked about in more detail during next week's webinar that has been scheduled for Tuesday, November 23rd at 11 a.m. I know many of you may be out of the office for Thanksgiving week, so just to let you all know that this will be recorded. Next slide. Also, new or updated winter planning resources have been posted on the HUD Exchange. This covers everything from a winter planning guide. There's updated alternative approaches and checklists and communication plans for you to check out. So I encourage all of you to download and take a look at those new resources. Also, as many of you know, there is new CDC funding for testing and mitigation that we talked about at the last office hours. There are going to be some webinars that are scheduled on December 1st, 8th, and December 16th to talk about this new funding that is available for public health departments. The audience for that webinar is homeless services staff or state recipients who are coordinating that work between their departments and their public health units. And then finally, this Friday, we are going to have a HUD office hours where we're going to have the Lawndale Christian Health Agency talking about their mobile outreach and vaccine efforts. We are going to be at the National Healthcare for the Homeless, are going to be talking about the new Biden administration vaccine mandate. And as well, we'll be touching on the new HUD TA vaccine resources that have been posted. Next slide. And then also the new ESG virtual binders have been released. Just so everyone knows, this is for ESG, not ESG-CV, still applicable to the work that you do in ESG-CV, but wanted to make that clear. 2 binders were released, the first on eligible activities and the second on program components. So I encourage all of you to check out the new ESG virtual binders. Next slide. And with that, I will turn it over to the corporate facts team for today's presentation.
Thank you, Natalie. Good to be with you today. My name is Bill Roeder, and I'm with Corporate Facts, and Andre and I are going to introduce ourselves in just a minute. The session today is, as it was noted, the Emerging Solution Grant Program and Financial Management Series. And we're inviting everybody, if you find other financial management issues you'd like us to cover, to let us know in the chat box. Our session today is going to be dealing with managing grant payments. We know you all have been managing grant payments for a very long time. That may have been even more intensive now that you've got your COVID funding. And we thought this would be a timely opportunity for us to talk to you about the way you need to go about managing your grant payment process. Next slide, please. Andre, would you like to introduce yourself?
Absolutely, Bill. Thank you. Good afternoon, everyone. A little bit about myself. I spent the last 28 years working for 2 regional CPA firms in the state of Maryland, where I was evaluating financial management systems and financial management statements. I've spent the last 13 of those years reviewing grantees that received more than $500,000 in federal funding to ensure the federal government that the appropriate administration of those federal dollars are being implemented. I'm also a certified public accountant and a certified financial planner, and I'm looking forward to going through this presentation with you folks.
Thank you, Andre. And I'm Bill Roeder with Corporate Facts. Before I came to Corporate Facts, I used to be a HUD field office CPD director for, almost 30 years, over 30 years. And I've been working as a consultant on a variety of HUD programs ever since I retired from HUD a number of years ago. Next slide, please. Okay, let's briefly explain. We have 2 principal objectives in the discussion today. The first, as we indicated, is to provide training to everybody, both for your regular ESG program as well as your ESG-CV program, because these rules pretty much apply to both. To make sure they're managed in accordance with all the applicable rules and requirements. And we're going to address this primarily from the standpoint of the federal rules and requirements. We also recognize, as states, you're oftentimes governed by state rules and requirements. So you really have to deal with both. One of the things we want to stress as we go through this today is that everybody out there needs to strike a reasonable balance. And that balance is between obtaining adequate grant payment documentation to support each payment, but at the same time, streamlining that process so it doesn't become unduly time-consuming. You recognize that you're dealing with a lot of third parties in this program who operate on a relatively small budget, and they cannot afford to wait for months to be paid. So what we want to do as we walk through this is help you to strike that balance between getting the proper grant documentation to support grant payments, while at the same time not making it overly burdensome to your grant recipients. Next slide. Okay, so what are the basic goals for proper grant management? The first thing is the umbrella federal requirements that apply to pretty much every federal program, and those are issued by the Federal Office of Management and Budget, OMB. And those can be found at 2 CFR Part 200 of the Uniform Administration Cost Principles and Audits rules, and particularly subparts D and E. And for those of you who might be new to federal jargon, when we use the term CFR, that stands for Code of Federal Regulations. And you can go online and pull out 2 CFR 200. And I actually keep a hard copy of it because I use it often enough. But those are the umbrella rules that apply not just to ESG, but to almost every federal program. In addition, you have to be sure you're compliant with your ESG regulations. Those can be found at 24 CFR Part 576. As you know, those regulations are fairly lengthy. We would encourage you to take a really close look at subpart F of those regulations, which deals specifically with grant administration. In addition, because of the COVID funding, you have to be aware of the special rules that apply to ESG-CV, and those were originally spelled out in Notice CPD 20-08 and recently updated to CPD Notice 21-08. So you need to have that, and you need to be aware of the special provisions that apply there. There are unique options for states that did not exist in your regular program. We'll talk a little bit about that later on. And lastly, you need to make sure you have adequate internal controls to protect your funds. That means having written internal policies and procedures. Written internal policies and procedures. When I was at HUD, we would monitor grant recipients, and they would have policies and procedure, but they weren't in writing. The problem with that is when somebody moves along to another job, the process breaks down. So you need to have written policies and procedures that govern how you handle grant payments. And then part and parcel to that is everybody knows you need to have checks and balances built into the system. The most obvious example is that you should never have one individual who can make a grant payment. It usually takes at least two. So you need to have reasonable checks and balances built into your program. Next slide. Okay, a couple of helpful reminders that we find that people get confused about. First thing I'm going to do is I'm going to use the term subrecipient frequently during this discussion. Subrecipients are those third parties to whom you provide funds to carry out aspects of your program. They might be other units of government. They might be other state departments of government. They might be nonprofit organizations. Those entities are, in effect, contracted to carry out aspects of your program. What's important to understand is subrecipients are subject to all the same federal rules and requirements that direct recipients are subject to. ESG-CV differs from the regular ESG program in one very, very important respect. As you know, in your regular program, states are basically required to suballocate those funds to third parties within the state. The ESG-CV program allows states to carry out activities directly if they so choose. So just be aware of that, and if you choose that option, that raises a number of other issues when you carry out an activity directly as opposed to subbing it out to a subrecipient. And you can find more information on that in the HUD notice that we mentioned earlier, CPD 21-08. It's important to understand too, some people think that if you suballocate your funds to subrecipients, that somehow that relieves you as a grant recipient of the responsibility to assure compliance with all the rules that come with the program. That is not the case. Providing funds to subrecipients and other third parties does not relieve you of that responsibility, and we'll talk later on about ways for you to carry out that responsibility that meet federal requirements. Next slide. Okay, so what are the basic goals for a proper management of grant payment system? First of all, as we mentioned earlier, streamline the grant payment process as much as possible. I worked with one large entitlement city early in my consulting career, and we found that it took over 6 months to make a simple grant payment of an invoice. Picture those third parties out there, the small contractors and nonprofits who are in need of those funds in a timely manner. You have to deal with this in a way that streamlines it as much as possible. As we said before, balance adequate internal controls with that need for prompt payment. And that balance is going to differ from grant program to grant program. Also, I think as you deal with this and you're receiving information from your third parties, you have to be looking over your shoulder and recognize that you have management information systems that you have to maintain, and you need the information to do that. That includes HMIS as well as IDIS, particularly IDIS. You need to be sure that you tie your grant payments process to that and you're obtaining the information that you need in order to maintain those systems properly. Next slide. The first of our really hard questions today. Question number 1. Adequate internal controls excuse me, I can't see that. Oh, I got it. Okay, adequate internal controls include written policies and procedures. True or false? Okay. I'm delighted we got 100% right. Okay, next slide. So the answer is true. All grant recipients and subrecipients must have adequate written financial policies and procedures. As I mentioned earlier, it's not enough to say, well, we know how to do it. You need to make sure that you have it. It does not need to be lengthy, but you need to know you have something in writing that governs that process so that you're doing it in a consistent basis that meets all necessary federal and, for that matter, state requirements. Okay, next slide. Okay, Andre,
Yes, sir.
I think
Everyone.
this is you.
This is me. Yes. Okay. The next 2 slides, we want to talk a little bit about payments methodology. And there are 2 methods of receiving payments for expenditures in administration of federal programs: the reimbursement method and the advanced payment method. The reimbursement method allows the grantee or the subrecipient to get reimbursed from the federal agency for allowable expenses incurred while administering the federal program. The expenses incurred must be based on actual expenditures for services or materials, and the payment to the service provider has been dispersed. The reimbursement is requested after the transaction has been fulfilled. Now, what would be sufficient documentation for the reimbursement method? First off, payments to vendors, documentation supporting cash disbursement, basically invoices, things of that nature will be sufficient documentation. For employee personnel expenses, things like payroll summaries, payroll summary schedules, and those payroll summary schedules should be documented by pay period to support what was actually dispersed to these individual personnel. Subrecipient costs. Supporting documentation could be cost of operating shelters, invoices, things of that nature, and things like street outreach, paying for taxi, vouchers, things of that nature to support those subrecipient costs for those people on the front line. And then client services, what else would be reasonable for those? Things like rent, motel, hotel vouchers, and transportation, etc. Next slide, please. Okay, the second grant payment option is the advanced payment option. An advanced payment method allows the grantee or the subrecipient to receive federal funds to cover anticipated cash needs for expenses to be incurred in the very near future, approximately 3 days or less. And that's the 3-day rule. If if you guys are using the advanced payment method, that's regarding the 3-day rule, or you have to disperse these advanced payment to a vendor within 3 days. You can't sit on those payments and use it for anything else. They have to be for the very purpose in which the advance was actually provided. So in order for subrecipients to be eligible for advanced receipt of federal funds to pay anticipated allowable program expenditures, they must meet the following criteria to CFR Part 200, specifically point 305 regarding payments. And the first one is a subrecipient must have financial management systems that meet the basic standards for fund control. That's saying that your financial management system is able to capture costs based off of the actual program or projects that's being ran at that particular operating level. So if you're running an ESG program, you should be able to run a report that identifies all the costs associated with that particular program to ensure that those costs that are incurred that you are incurring for the program does in fact benefit that program. Subrecipient must have written procedures to minimize times elapsed between receiving the funds and dispersing the funds. Talked about that a little bit earlier, but now we're saying those procedures must be written to ensure that everyone in your organization is aware of the policy that is on hand to disperse those funds immediately when you get advance payment. And if you're ever being monitored by if you're a subrecipient, you're being monitored by the recipient, that may be something that the recipient asks for to ensure that you are adhering to your policies and procedures in your organization. Cash advances must be limited to the minimum amount of cash needed and time to carrying out the purpose of the approved program or project. That means, again, back to that 3-day rule, you cannot take advances that are unnecessary to meet the immediate financial need of the program. Goes to the next bullet, which says cannot be paid in equal portions over the life of the contract or the award. Meaning that if you have a period of performance of a particular award, and a period of performance is 1 year, you cannot take 1/12 of that award each month to satisfy that those expenditures that's associated with the award. The payment must be for the purpose, the immediate financial need of the federal program or award in order for you to do an advance payment. And then, of course, documentation submission requirements must be agreed upon in advance in the subrecipient agreement. We don't talk about this into greater lengths, but I just want to touch on it as it relates to your subrecipient agreement, because it's important that when you put together your subrecipient agreement, you identify what the standard documentation requirement is as it relates to being reimbursed for the program or federal awards. Now, that's going to be just standard information that you have in your subrecipient agreement. Now, Bill going to touch further on a risk-based analysis, and that's going to determine what level of actual documentation that you're going to require from each one of your subrecipients based off of your assessment of their risk. But in the beginning, you need to have something in your subrecipient agreement to ensure that you have some expectation or provide some expectation to the subrecipient that there is some type of documentation necessary to support these federal awards drawdowns. Next slide, please. Oh, poll question. Any subrecipient can elect to receive advance payments, true or false? Next slide, please. Okay, we got true at 22%. I missed that. True at 22% and false at 78%. Let's see what the answer is. Next slide, please. The answer is false. Good. Only subrecipients that meet 2 CFR Part 200.305 requirement are eligible for advance payment. Very good. Next slide, please. I believe that's you, Bill. You're on mute.
Sorry, am I alive now? Okay. We recognize that there are limited resources that you have available to do the job that you need to carry out. I've yet to work with a grant recipient that told me we have more than enough staff to do everything we would like to do. So the federal government recognizes that, not only in the way of they conduct their business, but also in the way that third parties, grant recipients, carry out their work. And that's generally referred to as risk-based management, or in this case, risk-based financial management. So what does all that really mean? It means that you need to conduct a risk analysis, generally on an annual basis, although it can be updated from time to time, to determine what aspects of your program and which third parties are at greatest risk of having problems in carrying out the program. To begin with, we would recommend that if you're dealing with a brand new subrecipient with whom you've not dealt before, that would probably be someone that would not be a low-risk grant recipient. And you need to reevaluate those issues at least every 6 months. But everybody needs to develop a checklist, and we recommend that this be done in writing and that it be kept to record how you went about your risk analysis. So if you're going to develop a checklist to do a risk analysis, it usually is a numerical rating system, and it can vary from place to place depending on your program and your priorities. But some of the factors that you would take into account in doing a risk analysis for financial management. Keep in mind, you're now thinking about those third parties, particularly subrecipients that you deal with on a regular basis. One would be, do they submit their vouchers on a timely manner? If they do, that's great. If they don't, that's an indication that there might be a problem. Are there policies and procedures in place at the local level that include adequate record keeping requirements? And that will be verified at some point through your monitoring. Is documentation from prior submissions to you sufficient to substantiate the payment? In other words, you ask for timesheets to support their staff costs, and they don't provide those to you. That would be an indication of a problem. Do they have an accounting system that's in place that produces complete and accurate grant expenditure reports, as Andre touched on earlier? These parties normally have to have an annual audit from an independent auditor. You might want to look at those audits to see whether those audits indicate there are any internal control deficiencies that need to be addressed. And lastly, and probably most important, as a grant recipient, you have a responsibility to monitor your third parties on a regular basis. That can be a desktop review or an on-site review. In today's world of COVID, almost everybody is simply doing in-house desktop reviews, and there's probably very little, if any, on-site monitoring going on. But if you do your monitoring, we'll talk a little bit about that later on. Did that monitoring identify any findings or concerns that need to be followed up on? Those would be the kinds of things that you would take into account in doing financial management risk analysis. Okay, next slide. So what level of documentation would you ask in return for making a grant payment? You might require voucher documentation for subrecipients based on monitoring results. You've monitored a subrecipient and you found that everything was in order. And in that case, there comes a point where you might ask for less documentation. Conversely, you might deal with a subrecipient, you find there were serious problems, and you might ask for more documentation. Early in my consulting career, I dealt with a large northeastern state that had a very substantial state CDBG program. and I was asked to take a look at their process for paying vouchers. And they pointed me to literally a wall of filing cabinets that had reams and reams and reams of documentation with every voucher submission. I asked one of the staff who reviews all of this stuff, and they kind of smiled at me, and I got the impression that they gathered it just to protect themselves, that it was more than they really needed. So you have to ask yourself, is this information we really need, or are we just gathering it for the sake of documenting files? And a higher level of risk requires more documentation for each reimbursement request. When I was at HUD, it was very rare, but occasionally we would monitor a grant recipient and find there were serious problems. And in those cases, we might handle them differently than we would someone who did not have problems. So tie it to that level of risk that we talked about. And you can always adjust the kind of documentation you expect coincide with the specific experience that you have with that subrecipient. Next slide. Okay, let me give you some more specific examples of what we're talking about. For example, a new subrecipient might be required to submit their actual timesheets. As basic as this sounds, I can tell you as a consultant, it is amazing how often we find that subrecipients don't keep timesheets, or they don't keep timesheets that are adequate to show what portion of their work went to which cost objectives or which funding sources. So for a new subrecipient, I'd probably ask them to show me their timesheets initially until you're satisfied that they're doing that properly to cover their personnel costs. Experienced subrecipients could have timesheets reviewed during a monitoring visit. In other words, rather than having them submit them with their draw requests, you could just simply say, hold on to your timesheets and we'll look at them when we come out to monitor you. Or at some point, we'll ask for copies of them to look at. Also, I think a reasonable risk analysis consideration is the amount of money involved. You might have some sort of a dollar threshold that expects a different type or a different amount of documentation depending on the dollar amount of the draw request. Dollar requests over a certain figure, such as 5,000, might need more documentation than for smaller amounts. And I think another particularly difficult problem area is when you're dealing with capital expenses, such as a shelter construction or renovation project of some kind. I would be particularly careful about making sure I got documentation to support that because it usually involves construction costs. Okay, next slide. So again, adjust your risk based on experience and changing circumstances. It's important to note that this is not static. You may have a great experience with a subrecipient and then all of a sudden their executive director leaves and one of their senior financial management people leaves, and all of a sudden they've gone from low risk to high risk. That's expected. That sort of thing will happen. I would encourage you to document your risk analysis in your files. I remember when we first started doing this at HUD in the field office, our Inspector General's office came to ask us about risk analysis, and we said we did it, but we didn't have it in writing. We did it on a big blackboard, and when it was done, we erased it and off we went. It's a good idea to keep your risk analysis in your files for someone to see. You should communicate the rationale for your documentation requirements to subrecipients. Explain to them why it is you need the kind of information that you need. That helps, I think, in terms of their cooperation. You should conduct periodic desktop monitoring by requesting maybe even just a random sampling of information that goes with a draw request. That's a perfectly reasonable way to do it. Don't feel like you have to look at everything, but a random sampling makes sense. And by the way, when you do a random sampling, you pick the sampling. Don't let the grant recipient pick the sampling. And then lastly, in bold letters, we put this in here because this is an issue that we have found repeatedly. Reduction of voucher documentation does not reduce record keeping requirements. By that, I mean, If you choose to reduce the amount of documentation you request from third parties when you're paying grant payments, you still have to keep your records. You still have to keep the written records that go with those payments. So just be aware of that. Okay, next slide. Okay, poll question number 3. Risk-based financial management may need to be revised based on experience with the subrecipient and changing circumstances. True or false? Okay, very good. Next slide. The answer is true. Risk should be reevaluated. Don't feel like this is a static universe that you're working in. And it should be reevaluated on a regular basis. When I was at HUD, we used to do it annually for our grant recipients, and updated based on experiences and circumstances. And a couple examples. A low-risk recipient might have their critical staff turnover that could change their risk to high risk instead of low risk. That'll happen. Conversely, a high-risk recipient might become a low-risk recipient if monitoring shows good performance. Bottom line in all of this is you need to match the work you have to the resources you have to do it, and focus your staff resources on the areas that are most problematic. Next slide. Okay, Andre.
All right, I'm back. Okay. Let's talk about expense management and how internal control affect your expense management. So basically, adequate or inadequate program expense management is determined by your organization's internal control. So if you have effective internal controls, program management should be adequate. Now, what stipulates good internal control? Policies and procedures that govern the program expense eligibility, payment support, and qualification. Now, we could, stay on internal controls from now until the end of this webinar, because it's just a lot of information in internal controls. But for the most part, when you think about internal controls, you want to think about the tone at the top, or your control environment, which basically is how your senior leadership is disseminating information and expectation, specifically as it relates to financial management of your programs and awards and federal dollars. And you want to make sure that everyone in your organization understand what the what senior leadership expectation is. And in order to make sure senior leadership expectation is properly disseminated in your organization, that's where your policies and procedures come in place, because that is basically a written expectation of how you should manage financial activities within the organization. Case in point, if you have a accounts payable process that requires a triplicate matching process, an invoice, a requisition, and a invoice requisition, I lost the other one, and a voucher. You have a triplicate process. You have to match those up to ensure that those costs are being properly charged based off of the payroll, the requisition. Or if you have authorization procedures, you have to have 2 people signing based off of a dollar amount, like Bill spoke before. Those will be policy and procedures. So if those are written and disseminated throughout your organization and everyone's following them, the expectation of having any systemic errors going to or through to any of your reporting documentations or financial statements will be greatly limited. Now, voucher documentation requirement as indicated in your subrecipient risk assessment methodology. Now, Bill talked about the risk assessment and how you should go about determining what your risk assessment is for each one of your subrecipients. That voucher documentation should be documented in that subrecipient monitoring folder, as well as documented in the subrecipient grant agreement to ensure that both people, the subrecipient and the grantee, are aware of what the expectation is as relates to supporting vouchers for reimbursement. And then finally, the subrecipient and the recipient should both adhere to the grant agreements. And the grant agreements don't indicate the cost objectives or the categories that support the approved budget. And they're also going to identify the requirements to which the recipient and or the subrecipient must meet if a budget amendment are necessary. Now we're going to talk greatly about the budget or the approved budget that is documented in the agreement, grant agreement, or subrecipient agreement. And that budget stipulates how cost or the fund should be administered in order to administer the federal program. That's what the budget is going to do. So the expectation is for you, the subrecipient or the grantee or the recipient, to ensure that that budget, you're using that budget in a manner to which to identify how you are actually operating the award or the program. If you use a 1-to-1 ratio to identify the budget and identify how you actually charging the cost, it would be an easy way to determine if you are on track to meet the basic needs of the program based off of the budget. And then if there is an issue, it'll be easy to identify where the issue resides, simply because there will be a variance. And once that variance is identified, you can actually provide an explanation of what the variance is, why the variance occurred, and if the variance is based off of some issue that the budget did not capture immediately, you can ask for a budget amendment and explain why you need that budget amendment. Next slide, please. Now, what support is routine to submit with a voucher request for reimbursement? Now, each award should be reimbursed individually via its own voucher reimbursement request. That's basically, again, back to the budget to ensure that your request for reimbursement has sufficient documentation to support what was originally identified as expenses per the budget. If you separate these out based off a program, again, it'll be easily aligned and reviewers could be able to take a one-for-one review to determine if you are the subrecipient, if you are the subrecipient is following along the lines of the expectation of how those costs should be expended. Now, what should be in that voucher? In that voucher, you should have a cover sheet, and that cover sheet should indicate the reimbursement amount. It should identify the award, the grant, or the contract to which the fund should be drawn from. And it should be appropriately authorized with a signature from the appropriate person to sign off on it. Now, also, we talked about your financial management system. If you're able to ensure that your program expenditures are in fact following along the line of your project per your budget, you're able to capture that same information in your financial management system via a reporting of some sort. So you should be able to run reports from your financial management system that supports those costs that have already been incurred by your organization to administer the program, using the same manner of cost identification as identified in your approved budget. Again, that eases the review process, and it also allows you, the subrecipient, to stay on track with how those funds are being expended and ensure that you, the subrecipient, will be able to administer the federal award in accordance to the expectation of the subrecipient agreement. And of course, just to add more to it, you should have a program budget to actual reporting. Now that is, again, that goes along the same lines what we're talking about, but that's the actual budget, actual reporting process. And that should be done at least monthly to show you and to identify internally how you are performing as relates to your current budget process. Now, as Bill indicated, this is a lot of information that could be requested. But again, as a recipient, requesting this information from a subrecipient, it's all based off of the assessment of the risk that you have identified for that particular subrecipient. Now, this person is a high risk subrecipient. As a recipient, you may want to get this level of detail from them based off of your subrecipient monitoring methodology. If they're low risk, you probably want to reduce this level of support for these vouchers. It all depends on what it is that you've determined as relates to this particular risk related to this particular subrecipient. And after you identify the risk for this particular subrecipient, you should document that in the subrecipient folder. So it'll make it easy for anyone going through that to understand exactly what level of support is required for voucher reimbursement. Next slide, please. Okay, in this slide, we're going to discuss some budgetary support documentation that can support a voucher request and or assist in monitoring a subrecipient. First one is subrecipients should track and report expenses in a manner consistent to that of the budget in the grant agreement. Talked about that. The tracking of the budget in this manner enables the recipient to recognize program cost variances, allowing for ease in identification of unexpected activities. And also the budget adjustments, if identified, must be sufficiently documented and explain the purpose for the change. Again, this whole process is a way of ensuring that your administration of these federal dollars are aligned with the subrecipient agreement and meet the expectation of the funder and the grantee or the recipient. This process is something you can do internally for all your awards, not just your ESG award, but if you have all your awards, you can do the same process to ensure that you are meeting the necessary requirement for federal reporting purposes. Next slide, please. Okay, this slide is, this is a list of possible cost categories that are reimbursed or advance paid for federal programs or project administered by a recipient or a subrecipient. Then the first one is expense documentation versus documentation for compliance and monitoring. Usually, expense documentation, I say usually, expense documentation is significantly less than the documentation requested for compliance and monitoring purposes. This does not relieve the recipient or the subrecipient from maintaining good internal controls while administering the federal award. Even if you are a low-risk subrecipient and the grantee does not require you to support each cost item requesting to be reimbursed, you must maintain sufficient detailed documentation to support these program expenditures as designed in the Uniform Administrative Requirement as described in 2 CFR Part 200.302 for financial management. And some of the items of cost that we're going to discuss in the next few slides is going to be personnel costs. We're going to talk about what support you need to support a reimbursement of personnel costs. Professional fees for contractor expense. We're going to talk about goods and services that you may incur in order to administer a federal program. And of course, we're going to talk about indirect costs to some degree. And then from there, we're going to go to direct program costs versus general administrative and management costs. Next slide, please. Okay, first slide. Okay, here we go. Let's talk about personnel costs. Personnel costs per 2 CFR Part 200.30 of the Uniform Administrative Guidance identifies personnel costs includes all remuneration paid currently or accrued for services during the period of performance under the federal award. All. Now, what is sufficient support for personnel costs? Timesheets or personnel activity reports reflecting total compensated paid hours. And those personnel activity reports should identify the cost objective to which the staff was charging to at the period of time that they were working. So if they have multiple cost objectives during a pay period, each cost objective should be identified. Each program, each project should be identified to ensure that the appropriate hours that individual spent, that the appropriate hours that individual spent are being applied to the correct project or program. The second thing that you will need to support personnel costs will be payroll earning records showing total wages paid by employee and pay period. Those earning records are going to say, this is what this individual earned during the period that they were working these hours on this particular cost objective. Third item is there should be some type of conversion to where you turn those hours for those particular programs into dollars to actually be reimbursed. And we put these three together, that comes up with a sufficient documentation to support personnel costs that you're charging to a federal award in order to be reimbursed for the services that benefited that program. Next slide, please. Okay, fringe benefits. Per 2 CFR Part 200.431, Uniform Administrative Guidance, fringe benefits are allowances and services provided by employers to their employees as additional compensation outside of regular salary and wages. So what is sufficient support for charging fringe benefits to federal awards? Payroll tax records, that's a fringe benefit. However, those payroll tax records should be the employer paid taxes and the period for which the payment was dispersed. You can get that from your payroll department, or from, if you have a third party managing your payroll, you can pull that information from there. Medical, dental, and other benefits supported by provider invoices. Those invoices are for the premium paid on behalf of the medical and dental benefits that's being provided by your employer or the employer. And then retirement benefits. Those costs supported by employer contribution or payroll records. That should be easily identifiable as well if you get a contribution statement, which identifies how much of the employer contribution was allotted to each employee. That would be sufficient to support reimbursement of retirement benefits. And finally, paid time off is always a possible fringe benefit that can be reimbursed through your fringe benefit rate. And that should be supported by your compensated leave policy. And we're going to talk further about paid time off and how to calculate that with your fringe benefits in further slides. Next slide, please. Okay, fringe benefits again. I like to call these the nuances of fringe benefits, because we're talking about some things that a lot of people don't think about as relates to fringe benefits. And the first fringe benefit, first thing we're going to talk about as relates to fringe benefits is subrecipients can submit their fringe benefit rate to its cognizant agency for approval, or include the fringe benefit rate in the grant agreement for funder approval. So if you have a fringe benefit rate that you're utilizing as a subrecipient, that fringe benefit rate can be included in your subrecipient agreement to indicate how you are going to use your fringe benefit rate to apply to the federal awards. And that fringe benefit rate can be reviewed by the funder and the recipient for accuracy. All fringe benefit offered by the subrecipient or the recipient can be included in the fringe benefit rate computation. This includes payroll taxes, medical and dental, retirement, compensated leave. That's pretty straightforward and self-explanatory, and it's pretty much confirms the previous slide. Rates are typically based on prior year audit expenses. As per your organization, rates can be based on the prior year personal expenses as per your organization audit, or individually based on the direct charges of each staff member. Then there's two ways to calculate a fringe benefit rate, and we're going to show you one way in a upcoming slide, but there's two ways. And one way is to, and I've come across this quite a bit in providing technical assistance to quite a few recipients and subrecipients, is that they take the individual fringes that's applicable to each individual person that was charged to a federal award and identify the fringe that's applicable to that person and that person only, and basically do a computation to identify what was that person fringes, which creates a administrative burden to the subrecipient or the recipient. Another way that is a lot easier is you basically use your personnel expenses from your organizational audit or your payroll summaries from the prior period or the prior accounting period or the prior year. And use that as basically using averages of what your cost would be for fringe benefits. And we're going to talk about that in a further slide to show you how we can go about identifying a fringe benefit rate without basically looking at each individual person and the costs associated with their fringes for working on a federal award. Records must be detailed and support fringe expense applied to federal awards. So they must be sufficiently detailed, and they have to support all the fringe expenses that you are charging to the federal award. That's pretty much self-explanatory. We talked about records, we talked about support, and those records must be basically written records, and you got to be able to support those costs the way you're drawing them down. Fringe benefit rates require no additional documentation to support a voucher reimbursement. That's true. If you have a fringe benefit rate and it's previously approved and you want to use that fringe benefit rate, you can use that fringe benefit rate as long as that fringe benefit rate is included in your subrecipient agreement. You need to add that and make sure it's in your subrecipient agreement and understand that. So the funder as well as the recipient is aware. Normally, it does not require additional documentation to support. However, if the recipient or the funder requests additional support to support those costs that you are claiming as fringe benefits, and those fringe benefits are benefiting their particular award or program, it is their responsibility to monitor to ensure that those costs are appropriate and accurate. So if the funder or the grantee, the recipient require you to provide that level of detail to support, it is your obligation to provide that information as the subrecipient. Next slide, please. Okay, fringe benefit rate calculation. Here, what I want to do is basically walk you through a rate calculation for fringe benefits, utilizing prior year audit information and or a payroll summary. In this particular presentation, we're using prior year audit data. And in the prior year audit data, we identify salary and wages as $500,000. And in salary and wages, when you pay salary and wages, that include all your PTO, paid time off, holidays, vacation, and other, because these are salary and wages. We know that's included, that's standard. Now, as we go through the employee fringe benefit rate computation, which is the first segment of this slide, we want to identify how much of that $500,000 is attributable to each one of these fringe benefits. So the first computation, what we want to do, and I think this is probably the most complex computation, we want to do paid time off. And in this scenario, what I'm using is that each individual or staff person has 15 holidays in a year. So there's 15 holidays in a year times 8 hours, 8-hour day, 8 times 15, 120 hours. So now that's 120 holiday hours each year for everybody. Now the average vacation and personal sick day combined for each person is approximately 17 days a year. Now in your organization, 17 days may be too low, may be too high, but when you do this evaluation of your fringe benefit calculation, you identify exactly what will be your average vacation day to include personal sick and vacation all in one if you so desire. In this one, there's 17 days. So 17 again, time 8-hour day, 136 hours. The two, you add them up, you come up with 256 hours of PTO per employee. Now we take that 256 hours that we identified over a 2080 work hour year, which is your annual salary work hour year, and you come up with approximately 12%. So we're saying that 12% of the time spent working of 2,080 hours, 12% of that time, a person is out on holiday, vacation, or some type of paid leave. So we're saying that's on average what is transpiring for everyone. So we take 12% times $500,000, come up with $60,000 to identify as paid time off. And we do the same thing with payroll taxes, medical benefits, retirement, workers' compensation, and so on. But these particular costs should be easier to find because, again, you're going to have some type of report to identify what your employer taxes are. You can plug those in. Probably come from your payroll reports. Your medical and benefits that you're paying for those premiums, you're going to have invoices. We talked about those. Retirement, you're going to identify what the employer contribution was. If you have some type of retirement plan, that's going to be in employer contribution statement. Should be easier to identify. And workers' compensation is a bill as well. So in this particular presentation, we identified that total fringe benefits is $172,500. Now we know what our fringes were that we incurred last year to pay salaries of $500,000. Now let's talk about how we get to our allocation base or our direct allocation base to ensure that we are charging this fringe rate appropriately. Now, $500,000, we already concluded that in the $500,000, there is paid time off in it. So we can't charge paid time off as a direct expense and turn around and charge paid time off as a fringe benefit to the federal world. Can't do that. You can only do one. So in order to ensure that there is no double dipping or charging twice on the federal award, we have to pull paid time off out of the base. So we identified the paid time off is approximately $60,000 through our calculation. And we pulled that out of the base of $500,000. Now, total salaries is $440,000 less paid time off. Now we know what our base is and we know what our fringe benefits are. Now let's calculate our fringe benefit rate, which is basically taking total fringe benefits inclusive of paid time off, $172,500, and total salaries or our base exclusive of paid time off, $440,000. You come over with a fringe benefit rate of 39%. Next slide, please. Okay, here in this presentation, what we're trying to present to you is show you how one individual charging to one ESG program in this regard, how you would utilize your fringe benefit rate. And in this regard, compensation for this person, a 2-week period, is $2,500. This excludes any PTO expense. So when we calculated the rate for this person time spent, we did not include any paid time off in the computation of that rate. That's important. So that's how we got to 2,500. And then also, this particular person is on the front line there. So it must be some type of danger that they are constantly putting themselves into. So based off of the policies and procedures that's written in this organization, there is a hazard pay component. And the reason why I said based off the policy and procedures written in this organization, there's a hazard pay component, because you can't just indiscriminately decide to pay hazard pay simply because you can. You have to have your fringe benefits and your compensation identified in your policies and procedures. Hence, your internal controls are always monitoring to ensure that the federal awards are being expended appropriately. So this particular organization does have policies and procedures that allow them to pay hazard pay to individuals that are putting themselves at risk. And the hazard pay here is approximately 10% of this compensation that they would normally make doing this particular job. So total employee compensation here is $2,750 inclusive of hazard pay. Now, if we use our 39% fringe rate that we have calculated from the previous slide, we identified that fringe benefits that was attributable to earning these funds that was paid by the organization is approximately $1,072.50. Now, if you did not have this fringe rate, though that $1,072.50 may not be recouped. But now that you have this fringe rate, you can recoup the fringe benefits that are associated with earning those funds. There's an additional $1,072. Now, fully burdened is $3,822 that you have sufficient support for and can draw down for your federal awards and get reimbursed for those activities. Next slide, please. Okay, direct program costs. Now, some direct program costs that will probably be encountered, or most likely be encountered, working with ESG program, ESG and ESG COVID awards. Housing costs. And what do you need to support housing costs that you incur in order to administer the program? Things like rent receipts, lease agreements, utility bills. What about for temporary shelter? You would get, again, rent receipts, hotel, motel voucher receipts, things of that nature, just to support those particular items, costs, direct costs. And then also for transportation, taxi, motor vehicle, transportation receipts, etc. Shelter facilities, pretty much the same thing. You got your invoice, you got the insurance carrier, things of that, those costs that you incur in order to have a shelter facility to house different people experiencing homelessness. Those costs or invoices can be utilized to support those costs. And then ultimately job training, bills from training companies, or rosters based off of job training, identifying who came to the training, identifying the client that was there. Those would be also helpful to support those job training costs or bills. Next slide, please. Okay, other direct costs. We put professional fees and contractors along with materials and supplies, simply because they're very commonplace and they have some of the same requirements as it relates to support. And the first one is, when we talk about professional fees and contractors and materials and supplies, they're all direct program supplies, they're all direct program expenses. And things like invoices showing the materials or invoices showing the professional fees that was actually performed in order to administer award. are sufficient to support those particular items of cost. And then also with the same professional fees and contractors and material supplies for if services are rendered to an ESG client, invoices should include client name and date of services. Now that is more of a recipient requirement, recipient of ESG funds, and not an OMB requirement, because OMB doesn't require a individual to identify the recipient or the client name on the invoices, but that is something that's internal to the recipient. And that's quite all right, because again, that's their policy and procedure. If that's something that they need to support those particular items of cost, that's fine. And the recipient should communicate that need to the subrecipient and request that level of detail as it relates to supporting items of cost at the client level. And of course, you got to have proper approvals, which again goes along with your policy and procedure. What is the approval requirements for each dollar value? Again, if it's $5,000 or more, it may be 2, but again, that's up to the policy and procedures at the recipient level and the policy and procedure at the subrecipient level. But you have to let the subrecipient know if you want two signatures, you can identify that as well. It is up to you. Okay, and then ultimately, you can find professional fees and a lot more detail in 2 CFR Part 200.459, and also for material supplies, what details were necessary for that, and 200.453 in the uniform guidance. Next slide, please. Okay, let's talk a little bit about indirect cost reimbursement options. This can be a very convoluted, this can be a very complicated discussion, or simply because the information is very convoluted and it's hard to determine where one start and one stop. So what I'm gonna try to do is give you a quick overview of each one of these indirect cost reimbursement options and give you an idea of how they can be utilized. And the first one is probably the most simplistic one, if we can use that word in this presentation, because it's nothing simple about indirect costs, but this is probably the most simplistic one. It's the 10% de minimis rate. And this is a rate that is 10%, as the name indicates, but this is a rate that can be charged to modified total direct cost and be utilized by any recipient or subrecipient that has never had a negotiated indirect cost rate. And you can select to use this 10% de minimis rate if you are so inclined to do so. If you do meet the criteria of utilizing this rate, you can identify that you want to use this rate in your audit, and you also can identify that you want to use this rate in your subrecipient agreement or your recipient agreement. And further information as relates to this rate, you can read all about it. You can go to the Uniform Administrative Guidance, 2 CFR Part 200.414, specifically paragraph F. The next one, as it gets more complex, is the negotiated indirect cost rate agreement. And this is actually, you can go to 2 CFR Part 200.19 for this particular agreement, and you can find out about what this entails. So in a nutshell, this is an agreement or indirect cost rate proposal that has been reviewed by your cognizant agency. And in this particular example, cognizant agency is the one that provided you the most direct federal funding to your organization. So you will submit your indirect cost rate proposal to your cognizant agency for review and approval. Once you get that approval back from your cognizant agency, you can utilize that indirect cost rate, or you can apply that indirect cost rate that you calculated to the base of your indirect cost rate agreement. So if you have a base, which is salary and wages, or you have a base, which is modified total direct cost, you need to apply that rate to the appropriate base based off of your agreement. There. Next, indirect cost reimbursement option is the cost allocation plan. And this one can be very, very confusing because it's two ways to think about this. When you go to 2 CFR Part 200 and you look at the cost allocation plan, and in the new uniform agreement that came out in August of 2020, the definitions are in alphabetical order. So if you go into the definition section, I think which is General A, just scroll down to cost allocation plan. The description or the definition would be essential service plan. And for states, most people that use essential service plan are in fact states, and states have HHS normally as their cognizant agency. Now, those of you who are not familiar with essential service plan, which is an overarching plan that allows the state to perform indirect activities like motor pools, computer centers, purchasing, accounting, things of that nature on behalf of the operating departments within the state. And then those costs that they are incurring on behalf of those operating departments are pushed down to those operating departments based off of some reasonable methodology based on benefit received at the operation level. Okay, so that's one central service cost allocation plan. And then for others, when you think about cost allocation plan, you can think about a direct cost allocation plan. I told you it's convoluted. And that one talks about basically having direct costs in your organization that benefit multiple programs. And you need to have, if that's the case, and you need to share those costs for those multiple programs, you have some type of methodology to identify how those costs are being shared. And that right there is going to allow anyone that's reviewing those program expenditures to help them understand how you share that one cost for each one of those programs. Okay, so with that being said, the grant agreement must include provisions for reimbursement of indirect costs. So when you have your grant agreement, you have to include those provisions. You have to identify how you're going to spend those federal funds. If you got a de minimis rate, you got a negotiated indirect cost rate. If you're using a direct methodology, it needs to be in there. Okay. No documentation is required for voucher reimbursements requested using 10% de minimis or negotiated rate. That's true. Normally, once you select to use a 10% de minimis rate, you don't need documentation. Your negotiated indirect cost rate is already approved. But you're going through the monitoring process now. And right now, the monitor can't understand how you're applying these costs. They ask for additional documentation, additional support for these costs, you're obligated to provide it to them as a subrecipient. Subrecipients may, but are not required to include invoices or personnel records for indirect costs when cost allocation plans are used. Again, true, but again, if you're going through the monitoring process, you need to, the reviewer needs some type of additional support to justify the accuracy of utilizing that particular cost on an award. You need to provide that level of cost for that monitoring process. And then recipients should monitor subrecipient compliance with cost allocation plans, indirect rates, and fringe benefit rates. As the recipient, your responsibility to ensure that these cost allocation plans has been agreed upon in the subrecipient agreement. The indirect cost rates is in the subrecipient agreement, and the fringe benefit rate in the subrecipient agreement should be monitored to ensure that they are applying these methodologies and rates as identified in their approved indirect cost plan or NICRA, in their approved fringe benefit rate, and if they have a direct cost allocation methodology, make sure that those costs are being applied based off of direct cost methodology. Next slide, please. Question 4. Recipients can require subrecipients to submit documentation of general overhead expenses if the subrecipient elects to use a 10% diminished rate. True or false? Okay, 73% says true. Good. Answer is false. Federal regulations do not require documentation to support reimbursement of indirect costs if the diminished rate is selected. That is a true. That right there is true. However, again, as a responsibility for the recipient to monitor the subrecipient to ensure that that rate is being applied, the minimum rate is being applied to an appropriate base. An appropriate base is modified total direct cost. If the recipient needs additional information to ensure that that is being done appropriately during the monitoring process, they can request that additional information and have that information and review that information to ensure that the federal award is being monitored appropriately. Okay, so that right there is it's a mixture. So it was a good answer. Next slide, please. Okay, common voucher problems. First one is costs weren't actually incurred. That right there is self-explanatory. You should not submit for reimbursement of a voucher if costs were not actually incurred for that particular program. Costs were incurred for purposes other than intended or for another grant. So that's saying that, you know what, you identified costs that you incurred for your organization and you didn't appropriately assign that cost to the right award or federal award. And then you try to draw it down from the wrong award. So that's where the monitoring comes in, and you looking at your budget to actual. If you had your budget actual, you'll be able to see quickly exactly that cost does not belong. So that's something that you have to do as a subrecipient to ensure that your federal awards are being administered appropriately. You have to constantly look at your budgeted actual variances to ensure that those variances are within the ratio of percentage that you expect it to be. If you are 20% into the project and you've spent almost 50% of a particular line item, something you need to look at to see why is that line item expenditure so high. Have to stay on top of that. Costs incurred outside the grant period. You cannot expend any grant money outside the grant period. So ensure that you are performing all your administrative activities and direct program costs within the grant period. The cost is not adequately documented. It talks about documentation to a high degree. You got to make sure that your documentation is sufficient to support those costs that you are requiring to be reimbursed. Costs exceed or are not in the approved budget. Again, we're looking at that approved budget. You want to make sure that you're monitoring your financial management system in a manner that the approved budget is laid out to ensure that you have a 1-to-1 ratio. That will make it easy for you as the reviewer of your financial management system to ensure that those costs that you're incurring for a specific program is appropriately charged to the right program. And if you're doing a budgeted actual variances for each of your programs, it'll jump out at you quickly if you do this on a consistent basis. An indirect cost rate applied to the incorrect allocation base. That's it right there. If you're actually charging a de minimis rate, and the de minimis rate says that you have to use modified total direct cost to charge indirect costs. Have to. There's nothing else you can use. But in 2 CFR Part 200, specifically in the Electronic Code of Regulation, 2 CFR Part 200, if you go down in the definitions, you look up modified total direct cost. And it basically identifies all the different types of costs that can be included in modified total direct cost. And some things have to be included, some things have to be excluded. And in order to ensure that you are using all the appropriate cost drivers to charge this 10% to, there may be some evaluation of that base to ensure that you are charging that rate to the appropriate base. Take, for instance, one of the unallowable items that you cannot charge the 10% de minimis rate to is rental expense. It's unallowable. So if you have rental expense in your modified total direct cost base, that's going to give you a additional 10% on this rental expense that's not allowable. So that has to constantly be monitored as well, because you have to know exactly what's allowable to be included in the base and what is unallowable to be included in the base. Next slide, please.
Okay, Andre, thank you.
It's all yours.
I was looking in the chat room. We'll deal with it at the end, but as we expected, Andre, there are questions regarding indirect costs and the de minimis rate. So we'll talk about that at the end. I'm going to wrap it up with two quick discussions of things that I think are important. The first is record keeping. And for the ESG program, the specific details of record keeping can be found at 24 CFR 576.500. They're fairly detailed about all the aspects of your program. But the record keeping requirements apply to things like the status, homeless status of the individuals, matching requirements, HMIS input, and the Privacy Act, which comes into play when you're dealing with particular clients. So we would encourage you to take a look at those record keeping requirements so you know that you're keeping adequate records for all the things. It's a fairly lengthy section of the regulation. The other question we're often asked is, what is the record retention? How long do I have to keep these records? And there is no simple answer to that. There's also a provision, if you look in 576, 500Y, it details record keeping requirements. As a general rule, it's 5 years, but there are exceptions to that depending on the specific records that you're dealing with and the circumstances. So your general rule for record retention is 5 years. Next slide. Okay. One of the things, as you know, that you're responsible for as a grant administrator is proper monitoring of your program. What we want to do here is to provide you with a simple way to go about doing that. You do not have to reinvent this wheel. I remember when I was assigned a state CDBG program a few years ago, they asked me to help them prepare a monitoring handbook. And I said, but there's already a monitoring handbook out there that covers pretty much everything you need to know. And it's the HUD CPD monitoring handbook. When you're dealing with ESG, you can go to that HUD CPD monitoring handbook, and there's an entire chapter devoted to the ESG program. It includes specific checklists or exhibits that help you monitor specific aspects of the program. And we encourage people to use it not only to monitor your third party, but also to monitor your own program to be sure that you're doing everything the way it needs to be done. So in that CPD monitoring handbook, we would encourage you to take a look at it when you get a chance if you haven't already. A lot of states simply adopt something very similar to that as their monitoring handbook. It talks about how to do the risk analysis we mentioned earlier. It talks about how to prepare for monitoring reviews. And anything else, an awful lot of the work is in the preparation It talks about how to conduct a monitoring review, either on-site or internally, with an entrance conference and an exit conference, and looking at files and interviewing staff and so on. It talks about how to write a monitoring letter. It's not an easy thing to do. There is a recommended way to do that. You can do it that way, or you can use a way that you find useful. And then lastly, as I mentioned earlier, it discusses record keeping and the kinds of things that you have to show that you're adequately monitoring your program. And again, it's all risk-based. So you have to focus your resources, your limited resources, on those areas that you feel are highest risk. Next slide. Okay, poll question number 5. Compliance and monitoring of subrecipients is not required due to COVID concerns. True or false? Okay, 96% false. Next slide. You are correct. We understand that COVID has presented special problems for everyone, and that includes for those of you who have to do compliance and monitoring work. But it does not relieve you of that responsibility. What we would suggest, though, is you do like almost everybody else is doing, and you rethink the process. Obviously, you're not going to be able to do travel, probably not going to be able to do the in-person monitoring reviews that you might have otherwise done. So we suggest that you reconsider the methods that you use in this COVID environment. For example, obviously, you're going to do more remote monitoring or more desk monitoring in place of on-site reviews. So everybody understands that is something that is almost certainly going to need to be done. Next slide. Okay. We want to leave you with a very brief list. This is not everything, but these are the things that we think those of you who are dealing with this issue at the local level need to have. Obviously, your ESG regulations, which are found at 24 CFR Part 576. That ESG-CV notice that has some special issues related to CV funding. That's CPD 2108. The original, I think, was CPD 2008, but it was replaced by 2108. You also are going to need to have those OMB requirements, 2 CFR Part 200 that we refer to over and over again today. We also strongly encourage everybody to go to the HUD Exchange website. And when you're there, that's really your one-stop shop for information related to this program. While you're there, though, I strongly encourage everybody to take a moment to register. And when you register, if memory serves, you can actually indicate a specific kind of information you want to be notified about. I know I get regular email messages because I registered on the HUD Exchange when there's a new policy out there, a new notice that's been issued, a new federal register or regulation. That is a great resource for you to use. Then I mentioned the HUD CPD Monitoring Handbook, which is 6509.2, and I think the latest revision is revision number 7. That will help you in terms of doing the monitoring and compliance work you need for your program. I know this is not an ESG guide, it's a CDBG guide. I find it very, very useful because some of the requirements are virtually the same whether you're dealing with ESG or CDBG. And that's called basically CDBG, which is available. Just do a search for it, or you can get it on that HUD Exchange website. I would refer you to chapter 11 of that handbook, which I use a lot. That's the chapter devoted to financial management. Talk about some of the very issues we talked about today. And lastly, the Indirect Cost Toolkit for Continuum of Care and Emergency Solutions Grant Programs on the HUD Exchange. We think that would be a very useful item for you. Okay, with that, I think that was our last slide, and we're ready to deal with some Q&As. And if we can bring that up from, I guess, from the chat room, that would be helpful. And we'll do our best.
All right, thank you so much for the incredible presentation. Obviously, as we anticipated, there are a lot of questions. I think we can just start from the top and just work our way down, if that's okay with you. Tamara asked, or actually, let's go up even more. Tamara asked, what if you give a reasonable stipend provided during the job training? So I'm assuming this is a subrecipient who's doing some workforce development work. They're providing stipends to clients who participate in that training program. If that is the case, what documents should the recipient be looking for to ensure that the subrecipient is collecting the right documentation for the stipends?
Well, first of all, I'd say they'd have to have a policy in place that deals with stipends, who qualifies and how they qualify and what the amount might be. So there'd have to be a written policy and procedure in place to cover stipends. And then they just need to keep individual records. I assume these are stipends being paid, for example, to individuals who are engaged in training. It's permissible. You just have to make sure you've got a policy and procedure in place and that you're following that. Andre, Michelle, you got anything to add?
The only thing that I might add is that you might have each person that received that stipend sign a receipt for it.
Thank you.
Natalie, maybe go up. There's one even further up at the top there from Allah, maybe. It says, hi, can you please provide the advanced payment exception to CFR reference? And I saw that someone put in there 2 CFR 200.305. But the point that I would want to make about this is it is not the exception. I think we all think it's the exception, that they only get the cash advance on an exception basis, but it's really the preferred method. Many recipients have become risk averse to cash advance payments, probably because they've been burned along the way. But especially for small subrecipients, you don't want to put a lot of cash pressure on those agencies, especially those that might have gotten quite a bit of CV money. So it's really not the exception. That's the point that I want to make. 2 CFR 200.305 explains the requirements for it, but just keep in mind it's not the exception.
Got it. Thank you. I'm going to skip over to a question that we got in the Q&A from Jack, who asked that in a previous financial management presentation, I think this one is from about maybe 6 months ago, there was a slide provided by HUD that stated, quote, caution, financial management uses chapter 34 of the CPD monitoring handbook, not chapter 28, the ESG specific exhibits. Those are for the pre-2014 activities. So Jack was wondering if you all could explain the difference or the difference in requirements between chapter 28 and chapter 34.
Excellent. Jack has been paying attention. Correct. Chapter 34 is the chapter of the HUD CPD monitoring handbook that deals specifically with the OMB requirements that we mentioned, 2 CFR Part 200. So if you're looking at those issues, we would refer you to chapter 34. Chapter 28 was really the one developed for more what I would call programmatic issues rather than financial management issues. So when you're dealing purely with financial management, I would go first to chapter 34.
Great, thank you. Sean asked, sorry? Sean asked, does HUD have any recommendations for allowing subrecipients to pay for the costs of audits utilizing ESG-CV admin funds or allotting specific admin funds to help smaller agencies pay for required audits.
You want me to take that one, Andre?
Oh, I can take it. Hey, first off, I would suggest I don't see any specific regulations that allow for a audit request. However, for audit to be performed or HUD to pay for it, but that you can do that, but you have to do that in your indirect cost rate proposal. That would be an indirect cost that is occurred throughout your organization that benefit multiple awards. Although HUD is utilizing that, you have to share that cost amongst your organization, among all your funders using your indirect cost rate proposal. You won't be able to charge that cost directly to HUD.
Andre, I'd like to ask you a question. What if you're a small ESG recipient and the only thing you do in that organization is ESG funded activities? I would think because the only thing they do is ESG, in that case, they would be allowed to charge the audit as an admin expense. Because
Yeah, if that's all they do, absolutely.
Hi, this is Marlisa. I would agree with that. And if a recipient did share their admin funds with a subrecipient, that would be a great place to budget that cost.
Right.
Thank you. Tamara asked, what is the eligibility requirements for the 10% de minimis rate?
Andre, I don't think you mentioned the dollar figure that applies to de minimis. You might want to mention that also.
Yes. If you get direct federal funding less than $35 million a year, you can apply or select or elect the de minimis rate. Again, less than 35 million, you must have never had a negotiated indirect cost rate before, and then you can elect to use the de minimis rate using modified total direct cost.
Excellent. Thank you, Andre. Someone asked, for recipients, can you have a HUD designated, I'm assuming HUD approved budget with your admin costs plus a 10% de minimis rate?
I'm going to defer.
Okay, I wouldn't call those the same thing. And that's often the confusion, that admin costs and the 10% minimus rate are not really the same thing. And so if HUD designated you an admin rate, the only way they could have done that was through either a negotiated indirect cost rate, in which case you would use that instead of the 10% de minimis rate, or through a direct cost allocation, plan. But I don't think I've ever heard of them just giving you an admin rate. If what you're referring to is the 7.5% admin cap, that is really different than the 10% de minimis rate.
Mm-hmm.
Yep, thank you. I think there's a lot of confusion surrounding that. I've heard that question before, so thank you. Tamara asked, what documentation is recommended for reviewing indirect costs? I know that some recipients are funding sub-recipients who are submitting their budgets with indirect cost rates attached, either de minimis or federally approved. Is there anything that recipients need to do for reviewing those indirect costs rate requests in the budgets that they receive?
Well, a quick way of actually reviewing it, just if you want to look at asking for the indirect cost rate proposal, because in order to get an NICRA, they had to submit the methodology to which they calculated their indirect cost rate. Okay. So if you ask them for the indirect cost rate proposal, that should lay out exactly how that rate was prepared and what they should apply that rate to.
Excellent. Thank you. Someone asked, is advance payment for rapid rehousing rental assistance allowed so long as there is backup documentation to support the advance payment.
I can take that one. This is where Lisa, advance payment of rent, except when you're talking about just a few days in advance of the, the monthly due date, is not permitted. So that would have to be done on a month-to-month basis.
Thank you, Marlisa. I think that's a common question that we're getting at this time in our grant contract period.
But Marlisa, they can request an advance 3 days prior to that rent being due.
Correct. Yep. Yes.
Make that distinction.
Right.
So,
and so I was narrowly talking about like trying to pay a landlord 3 months of rent before it's due, like some situation like that. And Michelle, that's a good distinction to make between advancing funds like a recipient to a subrecipient, which can still be done.
Thank you. And actually, I wanted to do a quick follow-up on the stipends for the workforce development training that are being paid for by the subrecipient. Marlisa had a couple of thoughts to follow up on that.
I did want to just clarify that training costs for ESG are really limited to providing the training. So ESG recipients, for example, could use a training cost to pay for putting on a training for subrecipients. However, stipends to pay a subrecipient or staff to attend a training wouldn't be an eligible cost. So I wanted to draw that distinction. I think if anyone has a question about like specific stipends, then you could, please, I welcome you to submit an AAQ and we could look at the details of that. But for training specifically, that's likely to be problematic if you're trying to use ESG funds for that purpose.
Thanks, Marlisa. Tamara asked, what documentation is recommended for reviewing indirect costs? Is there like a list or something that they can refer to be able to determine what should and should not be included in indirect costs charges?
you're on mute, Andre.
Sorry. Well, when they're asking for the documentation is recommended for reviewing indirect costs, are they talking about the indirect costs as being charged to the particular program?
Yes.
Again, that would be the indirect cost rate proposal, because that proposal is going to provide the necessary details to identify those costs that was identified as allowable indirect and allowable direct. And they can only charge the rate that was approved by their cognizant agency to those allowable direct costs that they identified that they're going to use in their indirect cost rate proposal. So if they're using, this is getting long-winded. So if they're using salary and wages in their indirect cost rate proposal, and they decided to charge that rate to materials and supplies, that's also direct. That'll be unallowable because the rate was not calculated using those particular direct cost items. So you can determine what will be an allowable charge for that indirect cost by looking at what are the allowable costs per the indirect cost rate proposal.
Andre, I also just want to remind people in the indirect cost kit, there is great information on there about what's included in total modified direct costs and what needs to be excluded from that.
That's correct.
If I were monitoring a subrecipient and they were using the 10% de minimis rate, I would want to have that list of what are the costs that should be excluded from modified total direct costs, and make sure when you're monitoring them that those costs have not been included when they've applied the 10% rate.
Agreed.
Thank you. Someone asked, as a state recipient, how do you draw down either the 10% de minimis rate or indirect cost rate, whatever that is, in IDIS?
Where we at?
That rate is applied to a cost. And however you're recording that cost in IDIS, that 10% de minimis rate should be included in that total cost. It's not a separate cost.
Someone asked if HUD has a recorded in-depth indirect cost training that they can watch. I do know that there are financial management resources on the HUD Exchange that do include videos. And I can see if I can try to find a link. If not, I can send it out. They're a few years old, but they do cover indirect cost rates.
There's a toolkit.
And Erica, thank you. And Erica just posted the indirect cost toolkit, which is probably like the most amazing resource that's been published by HUD in the last couple of years, in my opinion. So if you haven't had a chance to take a look at that yet, I encourage you to click on that link and download that document. I am thinking as well as when we send out this, the webinar and the recording, I just want to clarify that I am going to also probably be sending out a survey just to get your thoughts on topics that you would like to see training on in the future in the financial management area, and also to get your thoughts on this training. And just to let everyone know that I'm going to get a list from Laura, who's running this webinar, of all of the people that attended today. So you do not have to have registered to get a copy of the webinar materials. As long as you are here today on this webinar, I'll make sure that you get a copy of it. I think a lot of people are hungry for indirect cost trainings.
We kind of anticipated that.
Yeah. Are there any other questions? We have about 8 minutes remaining. This is a great opportunity to just whatever you've got sitting on the back burner, any lingering questions that you may have. This is a great opportunity because we do have experts on the call that can answer your questions. If not, as Marlisa said, you can always submit an AAQ as well. All right, seeing none. I want to thank everybody for their time and their expertise for leading this training. We really appreciate it, the Corporate Facts team. And as I said earlier, I'll send out all the materials within the next few days. And in the meantime, if you have any questions, please contact your local TA provider, your field office, or the AAQ with any financial management questions that you have. Thank you so much.
Thank you, Natalie.
Thank you.
Thank you, everyone.